Commodities have taken center stage in this volatile and uncertain market. Copper's making headlines while gold has hit yet another all-time high as investors seek safe havens amid renewed tensions in the Middle East and weak economic data. For more on the changing copper market, let's get to Steve Schofstall. He is Director of ETF Product Management at Sprott Asset Management, which has a number of metal-related ETFs. Steve, thank you so much for being here. So we've already seen copper climb quite a bit this year, perhaps partly in anticipation of tariffs coming into place. But how are you thinking about the timing and how that's going to be affecting pricing?
Yeah, it's great to be here. It's a great question. When we start to look at the copper market, we tend to take a longer term view. What we really see with kind of the short term noise that we're seeing with tariffs is a lot of uncertainty. And in many cases, that uncertainty tends to be worse than bad news. But that's causing some fluctuations within the market. What we see is metal prices here in the United States are significantly higher than what we're seeing in other parts of the globe. That's causing metal to be sent to the U.S. ahead of tariff. Which sounds like they're going to come out much earlier than many had anticipated on copper. And in some cases, we see manufacturers are actually stepping up their purchases to try to get ahead of future tariffs. So from a short-term perspective, it's adding some volatility. We've seen spot prices rise about 17% so far year to date. And I think as we get some more clarity, hopefully in the next several days about copper imports or copper tariffs rather, we could see volatility come down a little bit.
Steve, I'm curious, tariffs, one reason. I'm just curious to hear what you think China and its role could be playing here too, just in terms of the incentives to boost the economy over there.
Yeah, so copper's actually undergone a fundamental shift, and it looks a lot different than it did 10 or 15 years ago. Back then, it was considered a bellwether for global economic growth. Things like the energy transition, technological innovation, rising standards of living in developing countries are all contributing to a structural supply deficit, in our view, in the coming years and actually out through this foreseeable future. When you start to think of the energy transition in particular, it provides a certain level of base investment and spending that really goes a long way and help support copper prices in those downturns and those down markets. Just to give you an idea, it took about 18 years for the average or the annual investment of the energy transition to reach about $1 trillion. It's actually reached $2 trillion now annually, just within 3 years after that. So we're seeing an acceleration in the energy transition and would expect that to be supportive of prices through troubling economic times.
So in other words, Steve, we used to talk about Dr. Copper all the time, that it had a PhD in economics because it was a good measure of what was going on in the underlying economy. It sounds like we should get rid of the doctor, not talk about it. I mean, do we need to just rethink here that it is not as vulnerable to economic cycles as it once was? Is that what you're saying?
Yeah, I think to a certain extent that's right. The global economic health does play an important role in copper, and I think there's still a shift in the mindset of many investors that still view it as Dr. Copper. But the increased investment that we're seeing on the energy transition, we see it on the artificial intelligence space and the data centers, urbanization, industrialization, all those types of projects require massive amounts of copper. And if you go back throughout history, if we go back to about the 1930s, the demand for copper actually increases, doubles actually about every 25 years or so. And we're seeing that play out and would expect the copper market to move into a supply deficit here in the next year or so and continue for the foreseeable future.
Steve, we've been talking about the metal. What about the miners, Steve? How well positioned are those copper miners right now?
Yeah, so these increase in prices that we're seeing, whether it's tariff related or structural and fundamental, which we see in our view, are generally well positioned. When we look at those miners that are pure play, and we think of those as companies that have at least 50% of their revenue or assets tied to mining copper, they have an all-in sustaining cost of mining about $2.41 a pound. If you look at where we're at today with copper prices, we're closer to $4.60 a pound. So there's significant margin that's being built in based on today's prices. And I think one thing that often gets lost in investing in copper miners is if you look at the 10 largest producers of copper, only 4 of those are majority copper producers and publicly traded. So that's really where our focus is on those pure play miners. And we think they'll be well positioned as we move through kind of this next stage of the commodity bull market in copper in general.
Steve, great to have you on the show today. Thanks so much for your time.
Thanks for having me.
Coming up, we break down the copper surge following the announcement of potential U.S. tariffs on the metal, possibly just weeks away. Now, Fernando Valle, managing director at Hedgeye, joined us to explain why he's bullish on copper.
Copper traded in New York surged to a record on the report President Trump previously ordered an investigation into potential tariffs on the metal to be resolved within 270 days. It now appears the report may be coming much sooner. Joining us to discuss, Fernando Valle, Hedgeye energy analyst. Fernando, thank you so much for joining us here. I want to pull up a chart if we can, just taking a look at copper prices stateside, hitting a record here, outperforming copper prices on the London Metal Exchange. I wonder where you see New York copper prices going, particularly given just the shift that we've seen in metals prices and kind of the impact of tariff prices on precious metals like copper.
Well, we've been bullish on copper despite what we define as a Quad 4 environment in the U.S., which is essentially what we're having inflation accelerating and just lower growth. So the reason for that is exactly what you mentioned. Is we think copper will follow a similar trend to what steel has done, which is ramp on the back of tariffs. The big issue that we see is that on our trading ranges is getting close to the top of the range. And so there might be some limited room here to grow. We think that that's already a little bit front run as it goes. But the one thing that I'll caveat that is we're expecting to see a large stimuli from Europe and China specifically, which has been the largest buyer of copper, and that could be a significant impact, positive impact, even after the tariffs.
So to what extent do you think we're nearing a top with copper, given the multitude of factors that you just laid out?
So in the near term, it's at the top of our range, so we think we're coming close to that near term peak.
Got it. And I wonder how you're thinking about just the shift in metals prices overall and how big an impact that could have on the prices of other, goods that obviously these metals are put into in the United States in particular. How should we be thinking about the impact that this lift in copper prices could be having just on everyday products?
So the near term, the biggest copper goes primarily into the construction side in the U.S. We are already seeing it. We've seen a slowdown there on the overall construction. So we aren't expecting to see again a huge impact near term. The biggest factor for us has been the slowdown from the economy itself. Obviously, you've had deflationary measures with Doge and others cutting some of that consumption. So when it comes into April, we expect to see a little bit more of an acceleration where we get incrementally more positive. But in the near term, we've seen more. We've been very bearish on U.S. consumption. We've actually seen capital flows going outside the U.S., as I mentioned, to Europe and Asia, where you're getting more stimuli and potentially recovery from what has been a very dire previous period.
Fernando, with the strength in China and the pivot for them to increase their economic growth, they're putting lots of orders in and buying lots of copper. They're one of the biggest importers of copper in the world. But with supply imbalances the way they are right now, are they willing to pay these high dollar prices for copper just to keep their economy going? And if their supply imbalances continue, we could see lower prices for copper down the road. This is what you're pointing towards as far as a peak in prices for copper?
Yeah, and more in the near term has been the U.S. demand side being weaker because, as we said, that Quad 4 is biting right now. As you mentioned, China, I think the stimuli is because their economy is struggling, and so they are going to try to increase demand. Is the same thing that we've said on the natural gas side, with the caveat that natural gas has already been strong because of the inclement weather in the northern hemisphere over the winter. We think there's going to be an increase in demand because Europe and China are stimulating their economies, whereas the U.S. has been trying to contract or at least trying to reduce some of the deficit with, again, acts like Doge and others trying to curtail some demand and then just the effect of prices itself. Going into April, we see an acceleration in overall demand, and that could be positive for copper.
I want to switch gears a bit, Fernando, and talk to you about oil. Obviously, a lot of headlines impacting oil right now, but I specifically want to talk to you about this idea that we may be moving towards a ceasefire between Russia and Ukraine. I first of all wonder if you buy that idea that we are moving towards a ceasefire, but also to what extent you think the end of this war could impact oil prices, if at all, just given the fact that we do know that China and India have been purchasing oil from Russia this whole time.
Yeah, as you said, there's very limited impact on the overall supply of crude. In fact, crude itself could decrease because one of the areas that Ukraine has attacked in the near term has been refineries and other infrastructure within Russia. So there may be fewer crude exports and more refined product exports from Russia if there is a ceasefire. As far as the likelihood of a ceasefire, I'm an oil guy, and my geopolitics are not as strong. But I take everything with a grain of salt. Covering energy for 15 years, you've seen that governments come and go on their promises. I think the overall impact on the oil side, again, the stimuli in these economies would be a much bigger driver than the supply chain, because, again, as you said, that oil is already getting to the market. If anything, it helps reduce some of the differential prices between Russian crude and others, increases the competition. So it could be bad, for example, for WTI versus Brent, but not necessarily for the overall Brent price.
Well, we always appreciate your geopolitical takes, Fernando. Thank you so much for joining us this morning. Appreciate it.
Thank you.
After the break, Daniel White, head of research at Blue Line Futures, shares the 3 commodities you should buy right now. You won't want to miss it. Looking for a safe place to park your money in this volatile market? This analyst reveals 3 must-buy commodities.
Gold hitting another all-time high as investors flock to safe havens with reignited tensions in the Middle East and weak economic data. Oil prices ticking higher after hitting 6-month lows earlier this month. Joining us now for a broader look at the commodities space and commodities investors should be considering, we've got Daniel White, Blue Line Futures head of research. Daniel, great to speak with you. You sent us 3 commodities to buy: soybeans, gold, and crude. I want to start on gold because we hit another record high, holding above 3,000 over the past 24 hours here. Do investors still have time to get in on gold?
Yeah, I mean, we're sticking with our longs. We're kind of riding the momentum here. We see de-dollarization continuing. The one thing we're eyeing on our gold longs is, resurgence of dollar strength. If you look at a dollar index chart, that's somewhat consolidating. So that's our kind of what we have our eyes on now. But we're riding the momentum with a stop below 29.74 right now.
Okay, and so how high do you see it going?
I mean, I generally don't like to forecast out, future prices because you never know what can happen. 3,500, I think we definitely look to take profits, but I'm not going to give you a concrete price forecast right here.
Okay, that's fair enough. That's a price target. We'll accept that, and that is perhaps a trade initiating marker, at least, that you're looking out towards in the future.
Yeah, absolutely.
Well, let's pick up on gold then. Let's pick up on oil because this is another commodity you recommend that folks buy. Why should folks be getting in on crude given all of the volatility that we're seeing, obviously, in terms of tariffs, but also geopolitical tensions?
Yeah, well, I sent you those notes yesterday. The picture has somewhat changed this morning. Israel launched strikes on Gaza, Lebanon, and Syria last night, early this morning. So there's been a reintroduction of geopolitical risk premia into pricing. So to us, that really makes the upside more attractive. Generally, we've liked crude. Global inventories have been running close to 10-year lows on a seasonal basis. The bearish sentiment comes from the forward-looking balance sheet. So right now, markets are fairly tight. So with the introduction of geopolitical risk premia, we really like that contract here.
I mean, especially considering the fall apart in some of the ceasefire that we've seen, how do you see that continuing to overflow into the oil market?
Generally, the models I've been looking at, there's a significant lack of geopolitical risk premia priced in. So I think that this could have some legs. The one thing to watch out for is a possible Russia-Ukraine ceasefire. That doesn't mean Russian barrels are going to flow back to the market right away, but I think that headline risk is something you definitely have to keep an eye out for.
That headline risk could come as soon as this morning. We know that President Trump was expected to be speaking with Putin this morning at 9 a.m. from the White House. We haven't gotten reports from that conversation yet, but we are expecting to hear lifting of sanctions. Potential truce is on the table. How do you avoid pricing that into your call?
Generally, we're sticking with calls and call spreads. In the May contract, we like the 71.75. I was pricing that up at around 67 cents this morning. You kind of get your upside, but you can avoid, any type of catastrophic downside risk.
Great. Let's end on soybeans. That's your third and final commodity to buy. What's the bull case?
Soybeans. So we're going back to NOVE, that's new crop soybeans. Planted acreage this season is looking light, around 84 million acres were the Feb estimates. We think that could be lower, around 83. We like the $11, $12 call spread. You get the growing season, you're good for at least one weather scare, and there's a Trump G summit being talked about for June. We're not necessarily betting on this heavily, but if there is talk of a possible trade deal with China, we would likely see a reinstatement of the phase one, which would increase soybean purchases, hopefully drastically.
Dan, thanks so much for taking the time here this morning.
Thanks, guys. I appreciate it.
Talk about gold for a moment here. It's up over 15% in the first quarter. The dollar, meantime, is heading for its worst month since 2023. So markets sending a clear signal. Safe haven demand is shifting, and macro portfolios may need to adjust. Joining us now, Axel Merck, Merck Investments CEO. Axel, it has been a long time since we've seen you, so it's very nice to have you here in the studio. As you know, gold has been sort of the it girl of the markets in the first quarter here, as people are looking for what they perceive to be a safer area. Do you think that is set to continue here? We've had a lot of banks, for example, raising their price targets.
Well, gold is always the thing you're glad you had with hindsight and never quite know where you have it for the future. And when it goes up like this, you got to wonder why. I happen to believe that we have some fundamental structural shifts happening. And we normally talk about monetary and fiscal policy. I actually think it's the executive policy that's driving gold higher. And that's because President Trump wants to have a trade balance in the world. And if you impose that by force, you risk disrupting financial flows. Remember, it's the current account balance that greases the global financial system. And ultimately, one way to think about the US is it's a giant hedge fund. It's like a bank that runs the world. You borrow in US dollars and invest for higher returns overseas. And when you disrupt those flows, something is going to break. Something is not going to happen, is going to be different. And remember, we have a tremendous deficit, fiscal deficit, so we got to finance that somehow. Now, the markets are not saying, oh my God, something is falling apart, but I think those buying gold are a little bit concerned that something might happen, and therefore more people are buying gold. It's one of the many reasons, I think, why the price of gold is heading higher.
Axel, do you this fundamental shift, as you describe it, do you think it's a fundamental shift? Do you think it's a dynamic that's well understood by investors?
Well, the market is smarter than I am. But the market isn't taking these concerns as seriously as I am. It doesn't mean they don't understand it. They might just say, hey, Mr. Trump is not dogmatic. He takes 2 steps forward, 1 back, and 1 side, and it's going to play out differently. And so in that sense, the market might be doing the rational things. I tend to be early and try to kind of project what might happen way down the road with these dynamics. I predicted the financial crisis in 2005, right? And even if those who predicted it didn't necessarily make money, the rules of the games were changing. So, and it's not like gold is the only answer to these issues, but gold is on the margin a beneficiary. Just as when the dollar started to be weaponized, central banks didn't suddenly take all the dollar out and put it all into gold, but gold benefits from this trend. And so it's just on the margin. I think one should be cognizant of these things. And if people believe those risks are significant enough, they may want to think what to do about them.
We talked to an investor earlier today who said if you are concerned about inflation, for example, and you want to hedge, it doesn't necessarily make the most sense to just buy gold, rather buy a basket of, say, metals or materials. Is that, do you think, another good way to approach this?
Well, I'm a simpleton. Gold is the purest of these metals, right? It's the purest reflection of the mania of our policymakers. When you go to silver already, there's industrial use, so the dynamics become more complex. In general, when there's light inflation, well, of course, right? assets tend to move higher. And so it really depends on the specific things. Right now we're talking about stagflation, again, in the news, right? And the reason why stagflation is not a one-time thing that happened in the aftermath of the inflation push had before is because the politically attractive thing may not be the economically sound one. Remember, President Trump called for lower interest rates in reaction to tariffs. Well, tariffs are supply shock. If you lower interest rates, you're going to cause more inflation. But politically, it would be suicidal to say, no, the Federal Reserve should hike rates. Right? So it is when you have this unstable environment, the odds of something going wrong are just higher because the political dynamics just take you off into very, very peculiar quarters.
Axel, you said a moment ago gold's going higher. How much higher, Axel?
Did I say that? I said that I'm a known insider buyer, so I might be biased. Clearly, gold has had an excellent run, right? I don't know what the price of gold is going to do tomorrow. I will sell my gold when policymakers come to their senses. And I don't talk about trade policy. President Trump can do whatever he wants on that. I'm talking about the bigger issues, the fiscal sustainability, entitlement reform. I don't see that on the table. Right? What's happening on Doge is all good, cutting some expenses, but to me that's more in the popcorn bucket. It's wonderful to watch that unfold, and of course it's meaningful to potentially cut some significant amounts. But in order to get the interests of the government aligned with the interests of the people, government finances need to be sustainable. And so I look at it in the long run. And if we have a repeat of the 70s, gold could go substantially higher, but nothing repeats verbatim, right? The history rhymes, it doesn't repeat itself.
Do you think that the dynamics for gold change at all if sanctions on Russia are lifted?
Well, they have changed. The price of gold has a 0% correlation to equities. The one thing price of gold is historically correlated to is real interest rates, so long-term real interest rates. Now, people say we have no idea what they actually are, but they are market indicators, and they are really a measure of the confidence in the Fed. And they started breaking down that, and by the way, the reason why that's correlated to gold is because ultimately gold competes with cash. If in the long run your cash loses value, you hold gold, otherwise why would you hold gold and not get a return on your cash? And so it's in that sense, but that correlation broke down when once the US started weaponizing the dollar. And so at this stage, all bets are off of what exactly it will relate to. The Russian ruble has clearly been one of the biggest beneficiaries of potentially peace breaking out. It's been steadily moving higher again. I think what you're alluding to is geopolitics more broadly, and there my glass half empty view is that what's happened in Ukraine and what's happening in Gaza are really just symptoms of a new era, that the long-term peace we've had since World War II is coming to an end, and those are just symptoms of this new world, where the US is not going to be the global police for, where old dynamics are coming back out. And what that means ultimately, just abstractly speaking, is that the cost of doing business is going higher. Also, that's very expensive. I mean, think about over $1 trillion in spending announced in Europe alone. All that stuff is. And by the way, Madame Lagarde of the ECB says defense spending is an investment in innovation and thus productivity. So she doesn't think it's inflationary, which to me means it will be inflationary. So there are those sort of things, regardless of how exactly Russia is going to play out, that I think the gold investor says, all right, well, maybe I hold on to my gold.
Yeah, and if you're waiting for that entitlement reform in the US, as you say, you'll be holding your gold for a long time. Axel, it's great to see you. Thanks so much for coming in. Appreciate it. Thanks for watching. Stay tuned to Yahoo Finance for the latest financial news and updates.